Welcome to 321 study. We're still looking at performance management, working capital. Don't forget that working capital is actually broken down into 4 basic areas. The introduction, which talks about the capital cycle, the finance, the objective of working capital. Then we looked at receivables management. We looked at inventory management. Now we're looking at cash, cash management. There's so many aspects of cash management. Now, but the major thing in cash management is you're trying to ensure that you have sufficient cash. Not too much. Now, you don't want to run out, even though somebody will say, let's have too much. No, what we mean is that you don't have too much idle cash, okay? It's either stocked in an investment or somewhere, but not too much idle cash, because that will lead to waste, theft and the rest. You expose yourself to some kind of risk that are avoidable. So in cash management, what models can we use in managing our cash to ensure that we are always liquid and not having too much surplus cash and not also having cash deficit? Now, one of the models is what we refer to as free cash flow. Now, free cash flow is the cash that is available to an organization after necessary expenses have been sorted out. Okay, so in free cash flow is your profit, you pay tax, you take care of working capital, you take care of your investment, you add back anything that does not involve cash. So in case you see free cash flow mentioned by error or by omission in your exam, because it's actually part of your syllabus based on the pack. So free cash flow, simple. In mathematics terms, I will say free cash flow is PBIT, less tax, add back any non-cash expense, then pay investment. So this is what makes up your free cash flow. The profit, less the tax, okay, on the profit, add back any non-cash expense. Non-cash expense includes depreciation, provisions, anything that doesn't involve actual cash flow. Then pay, settle your investment, both investment in working capital, investment in non-current assets, investment required to keep your current operations going. So that's free cash flow. That's basically what free cash flow it's all about. Now that we know what free cash flow is, what's the next issue? Now, another thing you could be asked is, maybe I've not mentioned it, the issue of cash forecast. Now, I'm assuming that we all do financial reporting or have done financial reporting, but we don't focus on that in performance management a lot. Now, cash forecast is your cash flow statement, whereby your cash, you have made a provision for your operating cash flows, your financing cash flows, your investment cash flows, so as to know what the cash balance will be. If it's going to be a net gain or a net loss, as a net inflow, or a surplus or a deficit. Another aspect of working capital that we also need to focus on is the issue of overtrading. Now, at times, organizations are undercapitalized. So, overtrading is another name for undercapitalization, doing more than your present strength or your present capacity. It means you're overtrading. Now, when you're overtrading, you are heating up the system. Now, when you begin to heat up the system, what happens? Your sales will be increasing, but your inventory and your receivables will be higher than even your sales because you are trying to do too much. Okay, so your current ratios will be going down, your liquidity ratios will be falling, okay, because you are doing too much. Your payables is going to be high, you're going to be owing people, you'll be trying to ensure people don't owe you, a lot of jam-packed system. Okay, so it's a very aggressive state. At times you may be asked to determine whether a company is actually over-trading. So you have to look at their current ratios. It will be falling down. If you look at their inventory, the rapid increase in inventory, because they load themselves with stock all the time because they are trying to ensure that every naira return is returned or is gotten back. But because they are undercapitalized, the advice would be, why not inject a little long-term capital to stem the risk? It's a very risky system, but profitable, okay? So when you begin to overdo, it's over-trading, okay? The next model we could use also is the Miller-Orr model. Now, what's Miller-Orr model saying? Now, Miller-Orr model tries to treat cash like inventory, like the other level. It sets an upper limit and it sets a lower limit. Upper limit to avoid having too much cash. Lower limit, I always like using a diagram to do the Miller-Orr model. Now, this is your Miller-Orr model. You have a long table like this. This is your cash flow. Okay. Now, you don't want to run out of cash. If you don't want to run out of cash, you set a lower limit. That's like a minimum level. So you set a lower limit. How much cash must be my petty cash at all times? Now, if you allow cash, it will become too much. So what do you do also? You set an upper limit. Upper limit is the maximum limit that your cash should get to. Okay. Some people do it. Now, the difference between the upper limit and the lower limit, we call it the spread. Okay? The difference between the upper limit and lower limit is the spread. Now, we always say you must not wait for it to get to the lower limit before you have so much problem, or the upper limit. You must set a control point. That control point here, we call it return point. And how do we measure the return point? It's usually 1/3 of your spread. So when you're doing Miller-Orr, 4 things you're looking out for: your lower limit, your return point, your upper limit, and your spread. Key things. Okay, we assume that we can calculate the volatility of your cash flows. We assume here that on a daily basis, there's going to be a constant usage of cash flows. So Miller-Orr model just tries to ensure that our cash flow is well managed. Now, in terms of calculation, or in terms of explanation, what happens here? If my cash flow gets to the lower limit, that means I'm trying to run out of cash. What do? I will sell investment. How much investment will I sell? I will sell investment. What's the difference between the return point and the lower limit? The essence is so that I will have enough cash that will bring me back to the return point. So when I'm getting to the lower level, I sell investments to get cash. Now, when I get to the upper limit, it means I have too much cash. What do? I buy investments. Investments worth how much? Investment worth the difference between the upper limit and the return point. The whole essence is to bring me back to the return point. So at any point in time, either from the upper limit or the lower limit, I'm actually walking back to bring myself back to the return point. Now, how do we do the calculations in Miller-Orr? Good enough, the formulas are going to be given. Now, but what are the major formulas that will be given? You'll be given the formula for spread. Don't forget that spread is the difference between the upper limit and the lower limit. So the examiner will give you the formula for spread. I need to bring that formula out. Spread is 3 times root 3, 0.75 times daily transaction cost. You know, we're trying to monitor your cash daily, so the transaction cost should be daily times the variance of your cash flows. I said variance of your cash flows daily times the examiner gives you standard deviation all over your daily interest rate. Okay, so what do I have here? I have a big 3. So I have a big 3 here. So spread is equal to 3 times this. Okay. So once I have my spread, I can determine my upper limit. My upper limit should be lower limit plus the spread. My return point should be lower limit plus 1/3 of the spread, on the assumption that my lower limit will be given. Let's quickly look at an illustration to buttress the issue about Miller-Orr. Don't forget, Miller-Orr is all about setting upper, lower, and a return point. The formula for spread will be given, but you won't be given the formula for upper limit and return point. Upper limit is simply lower limit plus the spread, while your return point is lower limit plus 1/3 of whatever the spread is. Okay, so let's quickly look at this illustration. It says a company sets a minimum cash account balance of 7.5. So my lower limit is 7.5. The average cost to the company of making deposits or selling investment is 18 naira per transaction. Okay, so cost of transaction, let me represent it with K, is 18 naira. And the standard deviation, remember we need variance. So, and they are giving us standard deviation per day. So variance is standard deviation squared. So that would be 1,000 squared. That's 1 million. Okay. During the last quarter. Now it says the average interest rate on investment is 5.11%. Now interest rate is assumed to be per annum. So in that case, to get our daily interest rate, we need to divide this interest rate, 0.0511, that's 5.11%, divided by 365. That's 0.00014. So, first question, calculate the spread. Now, what's my spread? My spread is 3 times cube root 0.75 times transaction cost times variance all over 0.00014. Okay, so 0.75 times 18 times 1 million. That gives me 1,350,000 divided by 0.00014. So we need the cube root of this figure. 9642857 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, so cube root 96428571430. So we have like 4,585 times 3. So we have approximately our spread is actually 13,757 units. Okay, we're dealing with cash, so it's Naira. Okay, so based on that, I have my spread. So that means my upper limit will be the lower limit, which is 75 plus 13,757. So that means my upper limit will be 21,257. This is my upper limit. This is my spread. My return point will be the lower limit plus 1/3 of the spread. That's roughly 12,086. So what that means is, if my cash gets to the upper limit, of 21,257, I will need to buy inventory worth this. I'll need to buy inventory worth 9171. So as to bring my cash back to 12,086. Now, if my cash goes to the lower limit, which is 75, I will need to sell inventory worth 12,086 minus 75, 4586. So the whole game plan here is, if it gets to the upper limit, you bring it back to the return point. If it gets to the lower limit, you bring it back to the return point. Upper limit, you buy. Lower limit, you sell, just to bring it back to the return point. So that's all about Miller or model. So formula is given, too straightforward. Most people say the reason why it was not tested at all, even at the professional level, was because it was too easy. I hope same will apply in the skill level. Now the next model we want to look at is Bomber model. Now Bomber model has the same assumption as the EOQ model. It treats cash as if cash is inventory. So the same model you used in the EOQ, the economic order quantity, the same assumptions. That's what the Bomber model applies in cash. The only things that will change is the terminology. So instead of calling it ordering cost, we'll call it transaction cost or conversion cost. You know, instead of calling it holding cost, we'll call it return cost and all those issues. So let's just pick this question. So in Bomber model, we're not wasting any time. If you understand EOQ, you should understand Bomber model. If you have a problem with EOQ, there's a high probability you have a problem with Bomber model. So what did we say about EOQ? To calculate the economic order quantity, we said it's 2 times demand times ordering quantity. Formula given. Don't forget, formula is given. This question should be able to help us. Examiner says, using the Bomber model, determine the optimal transaction size for transfers. Now, optimal transaction size in Bomber model is same thing as EOQ. Okay, so optimal transaction size is 2 times our demand. Demand is annual usage times our ordering cost, which is the transaction cost, all over the holding cost. Okay, so that means optimal transaction size will be 2. Our annual cash usage is 30 million. Our ordering cost per transaction is 160. And our holding cost is 24%. So can I have my optimal transaction size? So that will be 2 times 30 million times 160 divided by 0.24. Times 160 divided by 0.24. So 10 zeros. So that's 200,000. So that means our optimal transaction size is 200,000. Now the examiner says, what will be our average cash balance? Average cash balance is Q over 2. So if I have an average of 200,000 divided by 2, that gives me 100,000. So same thing we did in your EOQ. The third one says how many transfers. Now how many transfers is like how many orders, okay? How many transfers per year will be required? So if I'm looking for number of transfers, it's like number of orders. That will be demand over the quantity. Our annual demand is 30 million. And we are ordering 200,000 per time. So that means I will need 150 orders or transfers. Okay, so 150 transfers. What will be the total annual cost? Total annual cost, let me represent it with TAC, will be the total conversion cost, which is ordering cost, plus the total holding cost. Okay, don't forget again, total ordering cost, we said is ordering cost per order times number of orders, which is D over Q. And we said total holding costs should be holding cost per unit times average stock. Now we have our ordering cost to be 160, and we have our number of orders to be 150 transfers. We have our holding cost to be 0.24, and we have our average cash balance to be 100,000. So 160 times 150, what do we have? 24,000. 24,000. So that means our annual cost is 48,000. So if you notice everything we've done, same thing with EOQ. The only difference is treating inventory as if it is, cash as if it is inventory. So once you understand EOQ, you understand Bowman model. In fact, in the last question, the examiner says, what are the key limitations? Key limitations is we assume that the annual usage is constant. Will annual usage of cash be constant? No, in reality. We also assume that the transaction cost is constant. That's not true. Transaction cost varies, it changes. We also assume here that you can't run out of cash. That's a big lie. You can run out of cash. We also have not considered some other costs associated with cash, except the transaction cost here. There are other costs that have not been considered in this model. So those are some key limitations of the Bowman model. So don't forget, under cash model, you're looking at 4 things, 4 major methods. We talked about free cash flow. We talked about the Miller-Orr model. We talked about Bowman model. We talked about the issue of cash forecast. We talked about over trading. So don't forget, cash is a key area. You could be asked to prepare a cash budget, a cash forecast. So if you don't see it in budgeting, you could see it in working capital. I believe you won't have an issue. Now, under inventory, if you recall, we talked about EOQ. Now, everything we did under EOQ is applicable to BOMO model. Then the other level can be linked to Miller-Orr model. So an understanding of the calculations, they are given at the formula sheet, but how you apply them, okay? So in doing PM performance management, you need all the confidence level required to ensure that you do a good work. So cash model is actually the easiest amongst them. Miller-Orr model, formula is given, apply. Get to the higher level, upper limit, bring it to return point. Get to lower limit, bring it to return point. Whatever you do, don't forget what we've discussed here. Don't also forget the issue of free cash flow. Don't forget that you could be asked to calculate a cash forecast. So in cash management model, we have Miller-Orr. We have BOMO. We have free cash flow. We have cash forecasts or budget. And then you should be able to discuss or determine if a company is over trading. You should know the characteristics of over trading, the ratios to look at. So these are all the important highlights of cash management model. So with this, we've come to the end of this session. See you next session.